So, I've got this buddy Mark, who runs his own little web design gig. He's always going on about how he writes off his coffee shop visits as business meetings and stuff. Anyway, last week we're hanging out and he's bitching about taxes. I'm like, dude, are you just chasing deductions or actually planning this shit out? He gives me this blank look. So I break it down for him. I'm like, look, it's not just about writing stuff off. The way most small businesses are set up, like your sole proprietorship, you're leaving a ton of money on the table. With write-offs, you can't maximize deductions like you could with the right setup. Okay, say you need a new $1,000 laptop for work. Now, when you get paid by clients, that money doesn't all belong to you. The government's gonna want their cut come tax time, right? So let's say you're in the 25% tax bracket. Out of every $1,000 you earn, about $250 is gonna end up going to taxes. That leaves you with $750 to actually spend. I pause to let that sink in. So, if you want to buy that $1,000 laptop with your personal cash, you actually need to earn about $1,333. Because after taxes, that's what it takes to have $1,000 left to spend. Mark's eyes widen.
Shit, I never thought about it like that.
Now here's the kicker. If you buy that same laptop through your business, it's different. You can spend the full $1,000 on the laptop before the government takes their cut. It's like you're spending the government's money too.
Wait, how?
Because business expenses reduce your taxable income, so that $1,000 laptop lowers your profits by $1,000, which means you're not paying taxes on that $1,000. You only pay taxes on what's left after expenses. Mark leans back, looking thoughtful.
So I'm not actually spending more, I'm just keeping more.
Exactly, I nod. You're buying the laptop anyway, but by doing it through your business, you're using money that hasn't been taxed yet. It's like getting a 25% discount on everything you buy for work. Then I hit him with a real mind blower. But here's the thing, Mark. Most small businesses, the way they're set up, can't actually spend pre-tax dollars like this. The way most small businesses are structured, like your sole proprietorship or typical plain and vanilla LLC, you're leaving a ton of money on the table. You can't maximize deductions or use pre-tax money like you could with the right tax selection. Mark shakes his head.
Damn, I've been doing this all wrong.
Most people do, I tell him. It's not about spending extra. It's about being smart with the money you're already spending. You might want to restructure your business setup so you're not taxed as a sole proprietor. You're still taxed as the individual, you, not as a business, a separate legal person. And just like that, Mark realized he'd been leaving money on the table by not understanding how taxes really work with his business income. While deductions are important, they're just one part of a comprehensive tax strategy. Effective tax planning goes beyond just finding deductions and looks at the bigger picture of how to structure income, expenses, and business activities to eliminate overall tax liability.